What if the reason your wages have barely budged while your rent, your debt, your cost of living keep climbing isn't just bad luck, but a hidden war? What if the free market you trust is rigged in ways you've never seen, and the enemy isn't abroad? It's inside the system you rely on. Today we dive into how Wall Street, the global financial elite, and shadow networks unleashed a mechanism since 1971 to turn the middle class into anchor weights. Where are you watching from right now? Drop your city in the comments. And if you're ready for the unfiltered truth, hit subscribe, because what I'm about to show you doesn't play by the official rules. In August 1971, Richard Nixon stunned the world by suspending the US dollar's convertibility into gold. The post-war era's stable world of fixed exchange rates under the Bretton Woods system came crashing down. Sound familiar? It's the moment when money detached from traditional constraints and the global financial playground became wild. Sound familiar? Because today we live in a world of floating currencies, central bank printing presses, massive debt and asset bubbles. That shift began then. Because the same shift that unleashed runaway finance in the 1970s is what's compressing your paychecks and inflating everything you touch today. Back then, governments and banks swapped gold for promises. Today, banks trade derivatives and shadow debts for profits. You don't see it, but you pay for it. The stable system turned into a runaway machine. In the 1970s, we saw inflation surge, wages stagnate, unions weaken, and soon the rich pulled farther ahead. That pattern mirrors what the middle class experiences now, decades later. What changed? The rules, the mechanism, the players. Here's the critical switch. The mechanism isn't just the end of the gold standard. It's the rise of the shadow banking derivative complex, opaque vehicles, leveraged bets, hidden credit conduits, and instruments nobody reads but millions pay for. It was enabled by the decision to untether money from gold, by letting credit run wild, and by allowing financial engineers to create mountains of promises, obligations, and off-balance sheet bets. And the real players? Not just the visible banks, but a hidden network of financial firms, hedge funds, asset managers, rating agencies, all interlocked in shadow systems. You won't believe the name of the first giant trade that kicked it off. To understand how this war works, you must see how the wheels turn and why the stakes are enormous. After 1971, the breaking of the dollar gold peg freed central banks and finance to issue more credit. With fewer constraints, banks, insurers, funds created securitized debt, derivative contracts, repos, off-balance sheet vehicles, collectively, the shadow banking system. 1. Here are 6 vivid numbers to understand scale. The shadow banking system globally was estimated at around $62 trillion in assets in 2007. 2. Post-crisis, it rebounded. By end of 2015, it was near $92 trillion. 3. In August 1971, the US dollar was convertible to gold at $35 per ounce. That guarantee was ended. 4. The collapse of the old system led to the rise of floating exchange rates, and the global debt-to-GDP ratio exploded within a decade. 5. In the 1970s, inflation reached double digits in the US, peaking near 15% around 1980. Background context. 6. Wealth inequality began diverging sharply post-1973, with the bottom 50% of households' share of national income stagnating, while the top 1% soared. Imagine a pyramid of promises. Banks originate loans, package them into securitized vehicles, sell them off, issue derivative bets on those vehicles. Each layer builds leverage on the prior. Think of it like a house of cards built over a swamp, floating on unseen credit. When you borrow a home mortgage, your lender may sell that loan into a vehicle, which then gets sliced into tranches, wrapped into derivative bets by a hedge fund, insured by a monoline insurer, and so on. The original borrower may still pay monthly, but the risk has shifted far away. The middle class pays in other ways. Your employer-ES pension assumes a 7 to 8% return trajectory that depends on these opaque instruments. When the mechanism fails, you lose. Why it's war on the middle class? Because many of the players are too big to fail, they take huge risks. When they lose, the losses are socialized, but gains are privatized. Engineered collapse, periodic crises, 1987, 1998, 2008, are not anomalies. They are baked into the design of a highly leveraged derivative system. Wealth extraction. While you get inflation, debt, job instability, those who design the trades extract fees, derivatives payouts, asset price gains. Disempowerment of regular finance. Traditional banks and savings used to serve households. Now credit flows through shadow conduits the middle class can't access or benefit from. The 2008 crisis, when shadow banking collapsed, saw trillions of dollars of trades go bad. But while homeowners lost homes and workers lost jobs, the derivative counterparties were bailed out. The costs socialized, the profits privatized. Tie it back to 1971. The moment the dollar was untethered from gold, monetary discipline evaporated. That allowed credit to explode. That allowed derivatives not just to grow, but to become the main game. Without a fixed anchor, money itself becomes a tool of extraction. Impact on the middle class today. Your wages are stagnant because inflation and asset inflation eat them. Your debt piles up because credit is cheap, but it's layered with risk you don't see. Your home is expensive because finance turns homes into derivative collateral, not shelter. Your retirement looks shaky because pension funds assume the very shadow system that nearly crashed in 2008. All the while, Wall Street firms built ever more complex trades, synthetic products, credit default swaps, etc., turning risk into profit and your vulnerability into their upside. Ladies and gentlemen, we are not just looking at a runaway system. We are looking at a permanent structure built on borrowed time and hidden bets. The shadow banking derivative complex has grown global, instantaneous, and ever more detached from real economy, meaning the next crash won't just hurt banks. It will hit every job, every home, every community, every middle-class family. If you thought the crises of the past were bad, you were unprepared for what is possible when this mechanism goes full throttle. Trusting institutions built on credit, leverage, and opacity is betting on denial. The bigger the house of cards, the louder the fall. So here's the lesson. Recognize this war. Question the system. Don't assume stability. Because the financial elite that designed this mechanism don't care if your paychecks shrink, as long as their derivatives bets grow. If this resonates, share it with someone who still thinks it's just business as usual. And hit subscribe so you stay alert to the truth they don't want you to see. Are we wiser now? Or are we just walking the same path in better suits?